Hey guys, welcome in this video. I hope that all of you are doing great. So in this video, I'm going to share with you guys what I think are the different scenarios that we could see developing on the markets during 2023. So I'm going to share with you my opinion on what I think we could see on the markets, what are the different levels that I would be interested to position myself and stuff like that. So it's going to bring you guys a lot of value. I'm not going to hold back on this video, and my goal is literally just to make it as clear as possible so that you guys really understand what you need to look at during 2023 to actually have a better idea of how things can develop in the future. All right, so this video, as I said, will bring you guys a lot of value. So if you are excited for that, right, please leave a like on the video. I would really appreciate it, and again, it will help me grow the channel even more. And if you are not subscribed to the channel just as yet, make sure that you do it as well. So first of all, before that we start, I just want to make it clear that what I'm about to share with you guys can change totally, throughout the year, and it's completely normal, right? There's nothing that is always fixed, right? Everything is always evolving, and that's perfectly normal. So take it as what it is, right? This video is really important to watch right now, but if you watch it like a year later, maybe that it's not going to be the same, and the situation will most likely be very different, right? So it's important to understand that things are in constant evolution, and I'm actually going to give you guys the tools today to stay updated with this evolution and to have a better idea, right, on where to look for this information. So essentially right now, right, in today's video, we will focus on three things. We will focus on inflation, on the Fed, and on a potential recession. Okay, so these are really the three main things that I think will be important to watch during 2023. Now, there are other topics as well, such as the war in Ukraine or the reopening of China. I'm not going to talk about these things in this video specifically, but just keep in mind that they are also important and that they are pretty big topics that we will need to keep an eye on. All right. Now let's get right into it. Okay, so as I said, there are three things to look at: so inflation, the Fed, and recession, and we need to look at them in this specific order. And the reason why is very simple. It's simply that inflation, okay, is what the Fed is focused on right now, and this in itself will determine what the Fed will do. And what the Fed will do will determine if we have a big recession or not. And this will determine what happens on the markets. Okay, so it's really a logical process, step by step, that we can follow. And that's literally the best and the simplest way possible to look at these things. Okay, now just to put you guys a bit in context, right? So this is the S&P 500. I am on the weekly chart. And essentially, right, this was 2020. So the big market crash that we had with the pandemic. And around these lows right here, the central banks decided to reduce interest rates and to start printing a lot of money, right? So quantitative easing. And then after that, right, because of this, we saw a massive bull market. And this actually took an end in 2022 at the beginning of the year. And since then, we've been in a big correction, okay? And so throughout this bull market right here, we've had inflation that was just going higher and higher and higher. And every single time, the central banks were always saying, oh, don't worry about it. It's transitory. It's not important. It's not going to last, etc., etc., right? So they were always repeating the same stuff. And so in my mind, right, every time that I was hearing them saying this, right, I was like, they're so wrong, because inflation is most likely going to have a longer impact than what they think. And here we are today, right? So I was seeing this whole development, right, as it went on, and I had a pretty good idea actually on how things would go. And the reason why is very simple. It's simply that the amount of money that they printed was just absolutely crazy, and it was literally never seen in history before, okay? And so because of this, well, here we are today in a situation where the Fed needs to hike interest rate and where we have high inflation. So essentially what they're trying to do right now is that they're trying to, fight inflation so that it comes back down, okay? Because what is important for you guys to understand is that inflation, and I have it just right here, okay? Inflation is really one of the biggest threats to a economy, and it really has a massive risk, okay? And so essentially the target of the central bank for inflation is around 2%. And right now, year on year, we are still around 7%. Okay, so we are still very far from their objective, which is 2%. And so this, as I said, is quite of a risky situation. And so the Fed cannot really allow inflation to stay as high as that, and so they don't really have the choice but to hike interest rates to try to slow down a bit the economy so that inflation comes back down, right? So that's essentially what they are doing, and that's the reason why the first thing that we need to look at in order to have a better idea for the markets is where is inflation going, okay? And so here I have a few different charts that I want to share with you guys. So first of all, this here is one of the indicators that I prefer to use to have a better idea on inflation, which is essentially a used vehicle index. Okay, so the price of used vehicles. And so what happened is that during the pandemic, right, we had a lot of demand for cars, right, especially after the lockdowns and stuff like that. But the offer was pretty low. Okay, and so because of that, we saw a massive spike in terms of the price for used cars. Okay, and as you guys can see, we've already seen this started to go back down, and ultimately I think that because of how much the central banks have hiked interest rates, I think that this is most likely going to continue its downward path, and because of that it should actually bring inflation down. So this is what we call a advanced indicator of inflation. Now there are multiple advanced indicators, it's not the only one that you could use, but it's one that I like to look at and to keep it simple essentially, right? So if this is going to go lower, which I think it is because, as I said, the central banks have hiked interest rates so much, then logically inflation should also keep going down. And that's also part of the reason why that I think we've seen probably the peak of inflation right now, and that it is most likely going to keep going lower, okay? One of the metrics as well that is interesting to keep an eye on is the inflation month-to-month reading. Okay, so this is the long-term view, right, of inflation. Okay, we can see the years right here. This is the month-to-month reading. Okay, so essentially how inflation is evolving month after month, right? And what we can see is a very notable change between the first half of the year and the second half of the year, right? So during 2022. So we had a lot of inflation still at the beginning of the year, and since this summer, right, we've seen inflation really get crushed and for things to really stabilize a bit more, right? And if we really look at this data, right, I mean, we had 0 here, 0.1, 0.4, 0.4, and 0.1. So if we do a quick calculation, right, we will find that we actually only had 1% inflation during 5 months, okay? And so what that means is that we are not really far actually from the goal of the Fed, which is around 2% per year, okay? And so if things keep going like that, right, if inflation keep, going lower, which ultimately I think it is, well then, I mean, normally we should be back at, more normal levels in not too long, okay? And so the risk here that we have right now, I think, for the markets and for the economy is simply that the Fed does too much, okay? That they keep interest rates high for too long for no real reason, because inflation is already starting to come back down, and that this actually crushed the economy, right? So the next chart that I'm going to show you guys are interest rates in the US. So as you guys can see, since essentially multiple months, right? So around the beginning of the year, we've seen a lot of hike in terms of interest rates. Right now, we are sitting between 4 to 5%, and their projected target is around 5%, okay? Would it be 4.75? Would it be 5.25, right? We don't really know. And to be quite honest with you guys, a 25 basis point change in terms of the interest rate is really not that relevant, and it just doesn't matter too much, okay? But what actually matters is how long interest rates will stay elevated, right? So we've seen, for example, different hiking cycles, right, in the past, and every time, right, interest rates have stayed high for a certain period of time, and then they pushed it back down, right? And so now the question is, how long will interest rates stay very high, okay? And the longer that interest rates are high, the bigger the risk is for a harsh recession and a big market crash, essentially, okay? And so as I said, the problem here is that we already have a lot of evidence that inflation is starting to come back down, but the Fed does not want to take any risk when it comes to this, because as I said, inflation is one of the biggest threats for an economy, right? So they cannot allow to potentially risk not hiking enough so that inflation goes back up and then the problem is still there and it gets a lot worse. So they don't really want this situation to happen, and because of that they prefer to be more aggressive than less aggressive, right? And that's the reason why, even if we have, as I said, a lot of signs that inflation is indeed coming back down, well, it's not enough for the Fed right now to justify, cutting rates at some point or not, having them so high for so long. And so they are still right now in their mentality of, we will keep interest rates very high, we will not let inflation win and stuff like that, right? And so the longer that they stay within this mindset, the worse it is for markets overall, essentially, okay? And so that is really what we have to watch. And so this will be, as I said, really, really important. And so if they do keep interest rates too high for too long, it could actually create a recession. And we have different indicators for that as well, which I want to show you guys. The first indicator that I like to use is the ISM PMI. And, just to keep it simple again, right? Normally, when the ISM goes under 50, it's a sign that we could potentially get in a recession, okay? Now, it's not a indicator that works 100% of the time, because we've seen, for example, moments in the past where the ISM went under 50 and then it recovered and it was fine and the markets kept going up, okay? But the ISM PMI is essentially a advanced indicator for the GDP, okay? Which is the gross domestic product, which essentially a recession, right, is 2 consecutive quarters where we have a decrease, so a contraction of the GDP, okay? And so the ISM PMI is a really great advanced indicator of the GDP, and I have it right here, okay? So we can see that we have, so S&P Global Composite US PMI output, and we have GDP, okay? And what we can see with the blue line is that the blue line will always move a bit earlier than the GDP most of the time. And so if we actually apply the same thought process right here, well, we can see that the PMI is already under 50. And so if inflation let's say just maintains itself or even goes a bit back up or doesn't fall fast enough for the Fed, then the Fed is going to keep interest rates high for a longer period of time. PMI is going to decrease, and normally GDP should follow as well at some point, and this should probably get us in a recession, okay? So essentially that is one of the best advanced indicators that you can use to look at if we will get a recession or not. Instead of just waiting for the GDP, right? You can look at the PMI and have a earlier and a pretty accurate view when it comes to this, okay? So this is a really great indicator that I like to use. Another one are building permits, okay? It's not as precise as the PMI, so it's not the most important one, but it is still relevant. So normally when we have a economic contraction and where things are getting more slow and stuff, we get a decrease right here with this indicator. We can see that we are still relatively high. And so the information that this gives us is that if it wants to go lower, it has plenty of room to do it, okay? So this is a really important thing. And the unemployment rate as well is really important, because one of the goals of the central bank is to keep a strong job market, and a strong job market is essentially determined with a unemployment rate that is under 5%. So right now we are still at a pretty good place for the unemployment market. For the job market, sorry. And then if unemployment actually goes back up, then this is where it will be a potential sign as well of a recession, okay? So all of these different indicators are things that I actually do look at very often, and they are things as well that you guys can follow to have a better idea on this whole topic. And essentially, right, to keep it simple, and to really kind of give you guys an overview of this, right? The most important thing, as I said, is inflation. If inflation does not fall fast enough, if it stabilizes or if it goes back up, the Fed is going to keep interest rates high for a longer period of time. This could actually create a recession, and this would imply that the markets would go lower and make a bigger correction, okay? So that is one scenario that is possible. The other scenario where inflation really falls down quite quickly, then the Fed is most likely not going to keep interest rate high for this long, and that would actually be a pretty positive outcome for the overall economy and the stock market, okay? So these are really the two main scenarios of how I see developing in terms of fundamentals. I hope that this is clear. And the reason why, as I said, I focus most of the video on it is simply because within my own trading process, right, you guys know I look at fundamentals and then after technicals, but fundamentals are always more important than the technical picture because you want to understand what's really going on and then contextualize these ideas on the charts, right? Now, if we do this exercise, and as I said, we try to contextualize this overall fundamental idea, right? Now, in terms of the downside, so as I said, if inflation is still strong, the Fed keeps interest rates high for a long period of time, and then we get a recession. So in terms of the levels to watch for the downside, right? The first level on the S&P would be this level right here. So we have the lows of the year and we have the 200 moving average. So it's an interesting level. We also have the 50 Fibonacci and these previous highs. So that's a big zone right here. And so if the market goes to here, well, the first thing that we will be able to watch is, do we bounce from here or do we break? Okay. If we break, and if we are to make a bigger correction, the next level to watch is 3,200 right here. So we have two fib levels. The fibs are coming from this low right here after the pandemic to this high. So we have one fib here, and then I have another one from 2009 all the way to here, because at the end of the day, all of this is to me one big bull market. And so this gives us a lot of different levels to watch. And so this level here, 3,200, is a really interesting level. We have a lot of lows and a lot of highs around here. So if we are to get a bigger correction, I think that this level is definitely a possibility. If we get even a bigger correction, maybe this one here, this is not as big of a level. We have a few fibs here, but they are not as important. We have a few lows as well, but it's not as big, as I said, as this level here. And if it gets even bigger, right? I mean, who knows, maybe that we retest this overall big zone right here of lows and highs with this fib level here, right? That would be in the case that we get a really big market crash, and it would probably come if inflation goes back up and the Fed really just crush literally the economy and puts us in a big recession, right? So it's a more extreme scenario, but who knows, it's not impossible, right? Like if we measure the high that we had here with this low, it's a 50% down move, right? 54 essentially. Is it possible? Sure. You know, we've seen these corrections most of the time, well, not most of the time, but a few times in history, right? So I mean, if it happens again, you know, it's entirely possible. Now, as I said, it's not the most likely scenario. I think that the most likely scenario is that even if we get more pain, right, on the markets and we get into a recession and stuff, I think that 3,200 is already a pretty strong level. We will see if this holds or not. And so personally, what I would do, right, because I have different strategies when it comes to trading and investing, especially for the long term, you know, with the stock market, for example, right? So what I would do personally, and that again, that is just my own strategy, right? These are not financial advice or recommendations or anything like that. But if the market actually falls to this level, I'm probably going to buy some here. I'm probably going to buy some here, and I'm probably going to buy a lot more here if we ever get there. Okay. So this is how actually I could potentially get in the market. If not for the upside, we have this trend line that is, as I said, very, very strong right here. And so as long as we are under 4,100, it looks pretty negative in my opinion. But if we eventually get above this level here and we do a breakout, this could potentially confirm a next leg higher right here, and it could probably be interesting. Okay, so these are essentially the few levels that I'll look at, and as I said, it's pretty simple, right? If we get a bigger correction, I'll buy I'll average down right on the way for a long-term or a long-term investment. And if we break to the upside, I could apply, for example, a more classic trading system that I always do within my trades, and just go along and ride the wave, right? So essentially that's what I'll do. And as I said, it all depends on the fundamental side of it. So I'm going to pay attention to inflation numbers. This will give me a good idea what the Fed will do. What the Fed will do will give me a good idea of if we get a recession or not, and then it will tell me what I should do on the markets, right? It's pretty much as simple as that, and that's the exact process right there, my friend, that I will follow throughout 2023 so far, right? That's the playbook that I've came up with, and I think that, you know, normally it should go pretty well, and it should be pretty clear no matter what happens. Now, as I said, things can always evolve and change, and that's perfectly normal. So we will need to adapt, and that's part of being a trader. But we need to wait for this, right? So, for the time being, right, that's how I'm looking at it. So I hope you guys enjoyed this video. I hope it was clear. I hope I was able to bring you a lot of value as well. If you did enjoy this video, please leave it a like, and you can also share it with other people. And on that, take care, trade with care, manage your money well, and I will see you in my next video. Bye bye.